Hello everyone, this is Brooke, the DeFi analyst from Ethena Research, and in today's we would like to talk about interesting protocol called Mainstreet. Mainstreet is interesting in the sense that it's the first stable issuer of the option arbitrage strategy backed stablecoin called sUSDe. So when we first talk about option arbitrage strategy, it might sound pretty exotic and even a little bit dangerous. However, in the traditional finance, it's been widely adopted, and then there's actually a lot of financial product built on top of this kind of strategies. And then even on chain, Mainstreet is not the only player of this kind of strategy. For example, for Falcon Finance, which is the issuer of USDF, one of the top 10 largest stablecoin by market cap right now. If you go to the Claro page, transparency page, and then to check the Claro breakdown, you can see that over 60% of online strategies right now is made of option-based strategies. We can know that the option arbitrage strategy, even though it's a new concept, however, it's definitely not some kind of a weird strategy. And then in traditional finance, it's a very popular. And then in on-chain DeFi market, it looks like it's also getting more and more popular. As for the reason why we need this kind of new exotic strategy, and that is because for most of the existing strategies, the alpha are being diluted. So for example, for the Ethena sUSDe, it was backed by basic trading strategy. When it was first launched, the APY was from time to time above 20%. However, after a few months, there were a few new players, for example, like Resolv, Reset USR, and ROP, and there was also the USDX from Stable Labs, and there was also like the DUSD and USCC from sUSDe. And for Midas, there are also MAEV. They're all doing similar kind of basic trading strategies. In the last few months, sUSDe APY has been only around 5 to 7 or at most 10%, and most of the time it's near 5%. So you can see that the alpha has been very diluted and it's very compressed. So that's why all these asset managers are experimenting with the new strategies and also migrating the strategies come on TradFi onto the DeFi market. So that's the reason why we think this protocol is interesting, because Mainstreet is actually one of the first mover to adopt the strategy and issue the stablecoin on top of that. So now let's break down how Mainstreet put together the option arbitrage strategy. So there are several kinds of option arbitrage strategy, and the one Mainstreet uses is one of the more straightforward ones, called the box spread. To understand what's a box spread on a high level, it's actually a synthetic long with the lowest strike price plus a synthetic short with the highest strike price. So in the end, it put together because you have a long, a short, and the strike price of a long is lower than the strike price of a short. So therefore, you lock in the risk-free yield, and the yield is the gap between the strike price of the short and the strike price of the long synthetic forward. That is the whole idea. And that's the reason why we need a box spread, and also the reason why box spread can often capture this kind of risk. So here's the breakdown of the box spread. So let's first look at a synthetic loan. So for synthetic loan, it is a long call with a short put at a similar strike price. And then we need to keep in mind that the strike price need to be lower than the strike price of the shorts. And a lot of people might be thinking, why do I need to have a put option leg? Can I only have a leg? Yes, you can. So you can, if you don't want to have a put option leg, so it means that for your synthetic short, you also don't need to have a short call option. So it means that for your whole strategy, it will be long call and long put, and the call strike price will be lower than strike price. However, the option will be very expensive because it means that you need to pay premium on both legs of your strategy. So the reason why the threshold for box spread to identify risk review is easier is that because for both legs, we have a little bit of premium income. We buy the call option, however, we sell the put options. So the cost for this is actually cheaper than buying the option alone. And for this, we buy the short put option and then we sell the call options. So we have the synthetic shorts and the cost of is also lower. So for these two strategies, we still need to pay the premium to build a cost because the strike price of the put is actually higher than the strike price of the call. So it means that the put premium will be more expensive than the call premium. So it means that the whole spread, we still need to pay some premium for that. However, the point of the strategy is that if we identify any time in the market, the gap between the synthetic long and the synthetic short is larger than the premium we need to pay, then the whole strategy can make money. For example, if the cost to put together the strategy is $2,000, however, the risk-free yield, risk-free P&L we can lock in with this strategy is $4,000. It means that we have $2,000 risk-free guaranteed P&L. So that's the whole idea. Now that we understand how it works, the next question is, what about the risk? Because it's option, right? So option, there's always embedded leverage. And then when the market, there's drastic market volatility, will this position get liquidated? The short answer is very unlikely. And the long answer is that because we have a synthetic loan. Plus, we put both of these positions in one single universal account, sharing the same pool of collateral. Their P&L tend to cancel out each other. Because when the underlying price goes up, synthetic loan gaining value, however, synthetic short is losing value, so they cancel out each other and vice versa. So that's the liquidation risk. And then if you look at their back tested here, the drawdown analysis, and yeah, by the way, for Mainstreet, the online they're using is the S&P 500, so the index, and they are trading options on top of that. So for the back testing in the last 5 years, so here's a few of the max drawdowns. So for example, like the 2025 up to April 4th, there was a drawdown around like 6%. However, for the whole strategy, it lost around 50 basis points because both of them cancel out the P&L from each other. So that's the drawdown analysis. And lastly, let's look at the yield. So for the yield, it's actually very close to the T-bill race, which is around 2 months. And that is during a period of time when the APY when the volatility is pretty dampened. However, when the volatility is high, this kind of yield tend to be higher. And then for Mainstreet, they are currently experimenting with the on-chain asset, for example, BTC-E, to also build box spread around these assets. And so the reason why they want to experiment with this kind of strategy for on-chain assets is because of a few reasons here. So this section they explain how come this alpha can exist, given that there are all kind of people doing arbitrage strategy, and that's because they're like retail traders and market makers. So for retail traders, they don't really look at mathematic model. They don't really care about the Poco parity. So whenever they buy the options, they are more trading on the market view or on the directions. So whenever they buy, they tend to move the equilibrium, and therefore there's always some opportunity for Mainstreets to build position like this. And also on the other hand, when the market is moving a lot and the market maker tend to need to offload some of their exposures. So during this period of time, they also need to sell at a discount or buy at a premium. So that's the reason why Mainstreet can also find this kind of position. And this is for this. All these reasons are applicable for S&P 500 market and for the on-chain market, where people tend to be much less rational. This is even more true. For Mainstreet, they can find even more risk-free P&L. So let's look at the historical APY. You can see that for most of the time, Mainstreet APY is actually above 10%. And there's also some period of time when it was below 10%, but it was due to when the market was pretty quiet. As long as there's volatility, and then the Mainstreet can find a good entry point, and their APY can be very high. And right now, it is 12%. So that's the reason why we think this kind of protocol is interesting. And then we also believe that option arbitrage strategy will become more and more popular as the on-chain DeFi market trade options more and more often.